Welcome to Know Your Options, the Measured Risk Podcast.
The ultimate guide to navigating the volatile nature of the markets while managing risk purposefully.
Join us as we challenge the theory behind traditional asset allocation and dive into the mathematics of investing.
Whether you are a seasoned investor or just starting out,
this podcast offers valuable insights and practical advice to help you make informed decisions and manage your money wisely.
So grab a cup of coffee, sit back, and let's dive into the world of calculated risks together.
All right, welcome back to the Know Your Options podcast, the Measured Risk Podcast. And my name is Larry Kriesmer. I'm one of the principals. I'm here with my partner, Bernard Surovsky.
Hello.
And today we have a special guest who brings a wealth of knowledge and experience in this world of finance. And he's got a unique blend of physics background, which is kind of an unusual thing, and graduated from the University of Virginia with an MBA. And he's been in the financial service business since 2002. And is a co-manager and partner at Convergence Investment Partners, LLC. He's located here in San Diego. This business is located throughout the U.S., and we'll talk more about that. But welcome to the show, Justin Neuberg.
Thanks for having me, guys. Looking forward to it.
Yeah, thank you. So why don't you give us a quick introduction of how you got into, let's say, the early days of financial services. I think that was back in 2022. Is that correct? Or 2002?
2002, yes.
2002.
Right. So I graduated Virginia, as you said, with a degree in physics, and that was during the whole dot-com boom. And my cousin was working for a telecommunications company out on the tech corridor near Dulles Airport. And I got a job basically driving home from college, so I took it. It was an interesting job. I worked on computer networks. We were actually migrating computer networks from the old MCI network to the AT&T network. There's a joint venture between British Telecom and the U.S. company, whatever it was, and it was MCI. I switched to AT&T, so I had a little bit of technology experience there. Then decided to move to San Diego just for the weather and the surfing, and got a job with J.P. Morgan and was working in their mortgage company. Kind of a little bit of a tailwind for mortgages in the early 2000s, and ended up getting promoted up to be head of mortgage compliance for Southern California. And believe it or not, I decided to go back to business school to get my MBA in finance because I really enjoyed finance and investing and stuff of that nature. And after I got accepted, the last basically month of my experience with JP Morgan was part of a pretty massive internal fraud investigation in Southern California. There may have been an event that happened around 2008 or so that might have something to do with mortgages, but it was just a wild experience. I was working in the closing office and here in San Diego, and they sent me up to LA, the Inland Empire, and I was basically locked in a conference room with, 1,000 loan files on this side. And they said, look, none of these files are going to get funded unless Justin says it's okay. So the branch manager's literally banging on the door trying to get these loans funded. And I was sitting there trying to, quickly sift through these files, see which ones were the highest risk, lowest risk, whatever. And I could go on for an hour on some of the wild things that happened. One quick example is there were tons of these ninja loans, the no income, no job, no assets. One interesting factoid, the monthly income field on the application only had 5 digits. And so in order to justify some of these loans that we're going through, people would just put in $99,999 as their monthly income. That to me was a little bit of a red flag, especially when that person only had 3 credit cards, 2 of which were at Walmart for $2,800.
Oh my gosh.
It was a really interesting experience. But anyway, so I basically finished up that fraud investigation and then started business school. And I really wanted to go into investment banking. While there, investment banking basically disappeared. So my second favorite choice was to go into wealth management. Got a job here in San Diego with a small wealth management shop. Wonderful experience. Really, really enjoyed it. I was working with a great CIO, and it was, again, a smaller shop affiliated with a top 5 accounting firm. Anyway, maybe the top 8 actually. Anyway, they got bought out by a much larger national RIA. That I then became on the investment committee for them. Really enjoyed that experience. Got a lot of client interaction, a lot of financial advisor interaction, et cetera, et cetera. While I was there, I really decided I wanted to make a transition from the buy side to more of the sell side, working for an investment manager. And Mariner, the RIA, actually took majority pieces of boutique investment managers. The mantra was he wanted to bring institutional level products to retail investors. And so he took a majority piece of the firm I'm with now, Convergence Investment Partners, and I was able to move over. The fund manager at the time was actually here in San Diego. So he and I met, about 13 years ago, right around the birth of my daughter. And I was able to transition over and work for him. What I really liked about what we do at Convergence was a more systematic approach to stock selecting. While I was doing my investment manager due diligence at the RIAs, I always found it troublesome to try to justify a track record persisting into the future, especially if that track record was largely derived from, the star manager making one or two or three great either picks or asset allocations. I felt like that approach was less repeatable and less replicatable. So finding a manager that had a much more systematic approach to stock selection, I found very attractive. I never really thought that I was a quant or quant-ish, but as I was explaining some of the investment processes that I was using while at the RIA, Dave, the founder of Convergence, it was kind of like, hey man, I hate to break it to you, but that's pretty much quant style investing, looking for certain factors that are indicative of stocks that subsequently outperform. So I've now been with Convergence now for I've known Dave for 13, worked with them for about 13, came over officially in 2014, and just have really enjoyed my experience with them. But now I'm a co-manager on all of the products and just really love what we do. So we have just a quick background on Convergence. We have a proprietary stock ranking methodology that we apply to the entire US investable market. And we use that to build products, be it a long short, a dividend, or a small cap, whatever we need to do. You pick the universe and we can apply our stock ranking methodology. So it's a pretty flexible process that allows us to do quite a bit on quite a large number of stocks with less staff.
It's awesome. I'm going to follow up to your comments about the mortgage business because we had a young advisor in our firm that wasn't making it as an advisor. The really difficult part in this business is actually gathering AUM and getting clients in the door. And so this guy wasn't making it, and mortgages were huge in the lead up to 08. And so he left, joined a mortgage firm, I don't remember the name, and came back to us. It wasn't just, but a couple months later, and said, I've got this loan you guys should look at. It had 5 different payment methods. You could pick whatever payment plan you wanted. And one of them was 25 basis points, right? So what that meant, and I'm talking about annual, right? So on $1 million loan, the cash flow is about $220 a month. Now it was negative amortizing at about 6.5 or whatever the prevailing rate was. But if you remember at that time, houses were going up like 30% a year. And so who cared if your negative am was 6 or 7 or 8? It was just unbelievable. That should have been a tell for us to just go, something's terrible is going to
something don't smell right.
Yeah, this is not good. Because really anybody could qualify for that loan based on the payment.
You're right.
Yeah, I mean, so you didn't need $99,999 a month to sustain that kind of mortgage. So I always look at investment managers and I always judge their experience by literally the color of their hair or the receding levels of their hairline. And you don't seem to suffer from either of those. Your hair looks good and it's not like receding like that. I mean, I guess the secret to that is your approach, or is it just your outlook on life? How would you kind of summarize the healthy hair?
We have interesting criteria.
Well, it's just on more than one occasion, I've been on a call with people who trade options or trade other things. And, the first thing I say is, how much hair do you have? And when they tell me they're bald, I go, okay, I think you have enough experience for me now. So it's that credibility thing that comes with, gray hair or receding hair. But on a more serious note, you talk about these philosophies that you have. So I thought I heard you saying something that you can take your criteria and you can almost apply it to any asset class.
Not just equities, just U.S. equities. Sorry, any like division, whether it be large cap, small cap, dividend payers, or whatever.
I see. Can you talk a little bit about what are some of the things you look for without giving away the secret sauce? Was it?
Sure. So what really differentiates what we do at Convergence, I think, from a more traditional quant shop is that we were born out of a fundamental shop. So Dave and Todd originally worked at M&I Bank, and they worked on a large cap dividend paying equity strategy. And they had a team of analysts that would do, bottom up fundamental stock selection. And they really worked to try to systematize that process, identifying what factors they looked at for stock selection or for stock ranking, if you will. So we compiled basically about 200 factors and we aggregate those into 14 or so factor composites, or you can call them a factor signal. So we'll have let's say 3 or 4 value composites. So we have a traditional value, a relative value. We look at economic size. We have kind of momentum factors. We also have more forward-looking factors, like we have an earnings momentum factor and a sales momentum factor, which is looking at the projected earnings and the change in projected earnings over the near future. Actually, earnings momentum tends to be one of our better factors. It's one of our more stable factors. So we look at all of these factor scores at the industry group level. So the 25 industry groups now, thanks to GICS, they added another one to make it much more confusing for us. Anyway, we rank all the stocks within each industry group from most attractive to least attractive on our total score. And those scores can be broken down to those 15 factors that I mentioned. We have long factors and we have short factors. So again, I think that's another differentiator in that we rank stocks from most attractive long to least attractive long. And then we also rank stocks from the most attractive short to the least attractive short.
Oh, wow.
A lot of managers that had issues, you may remember probably about a decade ago, there was kind of an overabundance of 130-30 funds. And a lot of them kind of blew up because what they were doing was they were ranking stocks from most to least attractive, long in the top, short in the bottom. And what you're doing in effect is doubling your risk. Because if you have a factor bet, so then you're betting all on undervalued and then shorting all your overvalued names. Well, if value inverts, you're going to get double the impact. That's not what we do. So it is possible mathematically for a stock to be a recommended short and a recommended long because those models are different. So does that give you kind of a reasonable flavor of what we do?
I mean, it's definitely it's a different approach to what we've heard from other people on the interviewing process here. So it's really cool to hear something, with a little bit of a different thought process going into it.
Right. And then we're always on the lookout for new factor ideas, things that, we'll read research papers, we'll talk to people and try to identify what factors seem to be kind of creeping up as far as efficacy. Over probably the last 5 to 8 years, we've seen a real increase in efficacy looking at factors that involve free cash flow. Another one that I find very interesting, a lot of the academic papers that I'm sure we all read in our collegiate years, having to do with beta and having to do with like dividend yield and dividend payouts. I feel like that information has become very pervasive throughout the market, and it's just not as valuable as it used to be. Whereas your free cash flow is kind of a newer, last 15 years. It seems to be much more effective now at selecting stocks. And the dividends can be manipulated, whereas the free cash flow, it's what the companies actually generate.
Yeah, it's true. So you started out with a degree in physics.
I did.
And was math is kind of just your fun and games, mental athletics or something? Or
I've always liked math. I like solving problems. My mom was a math teacher. And so, I just like math. So I figured physics was a normal extension.
That wasn't something you chose to pursue. It was sort of sounded like financial services was more top
that's
of mind.
fair. When I finished undergrad, I was not ready to go right into graduate school. And no one needs a, bachelor's degree physicist. There just aren't that many of them out there. You might as well finish. We got another 6 years to go, buddy. And so I was ready to start working. I needed a break, and I don't know. I guess my career just kind of found its way. My grandmother was a big investor, very much into investing, and it was always something that I was passionate about and enjoyed. I just never really thought to pursue it as a career. And I just kind of, while I was at Chase and I was doing the mortgage work, I got a professional certificate in finance at UCSD, and I just to kind of see if I really enjoyed it. If it was something I really did want to pursue, and I really enjoyed it. I loved the financial statement analysis, looking at stocks. I just thought I found it fun. And if you can get paid to do something that's fun, maybe that's why I keep my hair. I don't know. I find
that's true, because I would not find that fun.
You're starting to sound like Warren Buffett now.
Yeah, exactly.
Oh, no, yeah, right.
Well, we're allowed to pay compliments, isn't it?
Yeah, I think so.
It's okay.
So you're a co-manager. You're actually on the investment committee with Convergence. Is that how this works?
We're a smaller shop. The founder, Dave, and I are the two portfolio managers. Todd is our chief technology officer. So again, so there's six. We have a compliance guy, a person that helps us with distribution, and then kind of an office manager that makes sure we all do our work. Todd does all the computer programming. We pull in probably about 3 or 4 million data points every night. And then we own all of our own factors, which I think is pretty commendable. We used to have a lot of our factors written in a third party's programming language. And probably about 5 or 6 years ago, we kind of got nervous. Like, what if something happens to them? Then we're done. So it was a really, really fun, probably about 2 or 3 year project of rewriting all of the factors in our own SQL code, and then reconciling to make sure the data points were all valid. It was a long project, but it was actually very beneficial in that we could verify all the data coming in was still clean. We got all our stuff from CapIQ. And then it provided us the opportunity to double check all of the calculations. So the calculations some of them were legacy from when Dave was working in his prior job. And then they migrated to Market QA, and then we migrated into our own personal SQL code. So we had 2 opportunities to verify all of the calculations and all the data points, make sure everything was very consistent. We also like to double check everything and recreate most of the factors using current data from Bloomberg. So I'll do the same calculations in Excel. And if my calculations in Excel match up with the old methodology versus our new SQL calculation, we're fairly confident that we're teasing out from the market data what we think we're teasing out, right? So Dave always says garbage in, garbage out. So we have to make sure when the data is clean and then that what we're doing is the math is right.
Yeah, we similarly have a very extensive Excel program that helps us manage our, controls, and same thing. You have to know as a human that sometimes that data output is like, well, that can't be, and there's an anomaly there you just can't take for granted.
Yeah.
In this process, one of the you mentioned your bias about managers and the star kind of pick here and there, that kind of thing. And I've heard you mention that you've got like a more compelling signal right now that appears to be the free cash flow.
Yes.
Obviously that comes from seeing what the outcomes are from the signals you get, and just getting more and more feedback, right? So as you extract something and you get results, then you see how those results work, and then fine tune whether or not you want to weight stronger on one thing or another. Is that a fair way of putting it?
So we review all of the factor signals. So let's take, for example, we have a valuation composite, right? We have maybe 20 or 25 value-ish factors. We may only use 12 in the composite. But every month or 2 or 3, we'll kind of run through a couple of the factor composites, and we'll say, okay, let's look at the suite of 25 and see which ones of these 25s are giving us good or bad signals, or some of them decaying, or some of them improving. Is there some, consistency to what is improving or eroding? And maybe we need to make a change out for one of the factors that's in the composite. Now, to aid us with that, one thing that we're actually really excited about in the last year and a half, 2 years, we have started to implement some machine learning type of methodologies for identifying factors that seem to be factors and composites and groups of composites that seem to be bubbling to the top. It's made it a lot more efficient for us because it's very laborious to pull up 25, 30 factors, look at it and see. And when we're doing that, you're only looking at one slice of time. So actually, one of our partners, his son just graduated in machine learning type programming. So we had him work for us this summer, and we did my knowledge of machine learning just exploded this summer. It was really, really very interesting doing some of the lasso regressions and doing some of the random trees or random forest. My partner jokes that it's called the rainforest methodology, but it's actually not. But so it's just been really neat because we want to try to figure out what ideas we're missing or what ideas we should maybe take another look at to see, maybe this is a factor that, hasn't really resonated with anything up to this point, but it's really done quite well. Is there something that we need to investigate further?
To what extent do like macro factors play into your modeling? Like, do you pay heed to, there's this geopolitical event taking place, or there's that?
That's a great question. We actually don't have any macro factors. And the reason, Dave and I, we've had multiple discussions about it, and it's just not something we've ever thought about, because macro factors are they're so difficult to put into your process, because sometimes, a good unemployment print can actually be a bad for the economy, or bad for the stocks, bad for stock market, and vice versa. And so it's hard to get the log right, whether you wanted a positive one or a negative one, whether the print's good or bad. Like right now, everyone's so nervous about the Fed hiking rates. When you get a good unemployment print, then everyone gets a little bit nervous that they're going to continue raising rates, right? So it's actually a bad. So we don't do that. So what we think is a better methodology is just looking at the stock level data. And when stocks that do better in a certain economic environment are performing better, then the factors of those stocks will be scoring higher, and we'll be weighting more towards those factors that tend to be held by stocks of similar nature, if you will.
So do you find on balance that you become more kind of momentum than contrarian, or is there no real hard and fast answer on that? Because one would think that if you're getting positive somethings on factors,
we were pretty heavy momentum around 2017, 2018. And a lot of it was just because the market was really momentum driven. It was an all beta type environment. So it can happen, but to kind of counter that, we have two main scoring methodologies. So again, we take all this information, we put them into signal composites, and we try to come up with what we call our super composite scores. And we have one super composite that is equally weighted. We call that our strategic score. In other words, all 14 composites for the long model, they're equally weighted. The environment doesn't impact the scoring at all. Another one is our tactical model, where it says, okay, given the industry group, let's say capital goods, of these 14 factors, which of these 14 has been most effective, which few have been most effective at identifying winners, subsequent winners, and which factors have been least effective. And our model will tilt towards the factors that tend to have been more effective. And then we take kind of the combination of those two scores. That's kind of where the portfolio manager decision-making comes in. We will rank the stocks from most to least attractive on our tactical score, but then we want to see corroboration from our strategic score. So
do you find it within the portfolio itself? Do you ever take what would an overweighted position look like in terms of a percentage of portfolio? Is it a 4% allocation? Is it a 14% allocation? What is it?
Let me back up. So when I'm talking position, or when I'm talking the factor tilting, that is, we are overweighting the contribution of a stock's factor score to its aggregate overall stock weight, or stock score, excuse me. So let's say you have and all the stock scores it's just a simple Z-score, standard deviations from the mean. So if Microsoft has an aggregate score of 1.1, and then the next software company has a score of 1.0, we would go with Microsoft. Now, the weighting in the portfolio is a whole nother situation of the individual position. So to talk about the weighting, in general, we want to equally weight within the industry groups. But we've found over the last probably 5 years, it's more effective to have kind of what we call a cap-aware weighting scheme. So if there's a 10% weight to energy, and there's 100 stocks in the energy group, we want to be long typically the top decile of energy. So that would mean we want to be long 10 tickers. So if you want to equally weight those, we want a 10% weight, each one gets a 1% weight. Now, you're going to find in the energy group, you're going to have some big fat cats up here and some smaller cats. So we will tilt towards those. So those might have a 1.2 or 1.3% weight, and we're going to knock these other ones down to 60, 70 basis points.
I see.
So it's not purely based on market cap, but it's definitely cap aware. And our short book, to make this an even more difficult answer, and I know I'm going on too long, The shorts are equally weighted just straight up. So we try to weight those, like with the energy example, it'd be 1% across the board, because we don't want to take too much idiosyncratic risk with our short book.
Yeah, makes sense. What are some of the activities you enjoy doing? Let's talk a little bit about where you live, San Diego. Some of the you mentioned earlier, I think that
Sure.
enjoying the outdoor life. You want to talk a little bit about around like what do you do to kind of relieve some stress to give you more time to focus on managing client?
I'm super into mountain biking right now. So I have a good group of guys, and we typically go ride on Thursday nights. And we'll also ride a couple times during the week if we can get over mission trails or over to Santee or something like that to try to hurt ourselves. So I really enjoy that.
What's the gnarliest wreck you've been in or witnessed?
I'm kind of a sissy. I don't push myself that hard. I did have a really bad fall Halloween a year and a half ago. It was at the end of a very long ride. I was feeling way too confident. I'd even hit a few jumps and stuff like that. And we were literally riding out. It was the end of the ride, and there was just some rock with some loose dirt on top of it. The problem was I was probably going about 20 miles an hour, and I had no business going 20 miles an hour at that point in the ride. Again, we've been riding for a couple hours, so we're exhausted. And I just fell down so fast, I didn't even get a chance to pull my leg out from under my bike. So skinned my whole leg up, and I hyperextended these 3 fingers. And it still aches to today. So that was about a year and a half ago. So that was, yeah.
It's actually a good lead in for risk management.
Yeah.
Because
Yeah.
It's one of the things that we're phobic about measured risk is that whole thing of what the drawdown can be. So when you have a year like last year, 2022, and the market starts to sell off and gets heated, do you have stops or some kind of just punt to cash, or do you what's the response to that type of environment? Do you just continue to run your models and find better stocks to own, or does it sort of hold still? And just kind of give me a feel for how that behaves.
So we always kind of keep an eye on risk and make sure we're making prudent decisions. So we have tweaked our process quite a bit over the 15 or so years. One of them was implementing that cap aware weighting scheme. We were a little bit more cap aware probably about 10 years ago. So that was one thing we did to try to minimize stock specific risk. Another thing is we really keep a close eye on our hedge ratio. So when trades start to go against us, we will rebalance that hedge ratio back, usually within 28 or 48 hours, just so that we don't want to let things run too far. So we really want to make sure we're keeping our hedge ratio on that strategy, on our long short strategy, very much in line with what we want. We are very diversified. Again, we're long the top decile and short the bottom decile. So we have about 130 to 140 longs and close to 170 shorts. And the reason we have 170 shorts is there are certain industry groups that present significantly higher idiosyncratic risk. So for example, pharmaceuticals, right? Or biotechs, pharmaceutical biotech, same group, but biotech names, you can get it handed to you if they get an approval that you're not expecting. And so to minimize that risk, instead of being short, so let's say it's 120 stocks in the group, we want to be short 12, we're going to push that up to 17 or 18 and just take a smaller position. And what we do at the end of the day, the positions that we take, long or short, we want them in aggregate to be providing to us the factor exposures that we believe are going to be rewarded or punished in the subsequent month. So if we do it with 10 stocks or we do it with 15, that the aggregate factor exposure should remain quite similar. We just want to get that factor exposure with as little idiosyncratic risk as we can without being excessive and shorting 700 names or something.
Yeah, but it doesn't sound like you're moving to cash or just going to the sidelines.
No, we don't. We really don't manage the cash allocation in that regard. We try to stay really, really rigid with our hedge ratio. And we believe the responsibility of cash management should lie with, the financial advisor or the investor. We don't want to tell them we know how to manage cash. We're not making a market call. We're just saying, hey, we're going to provide you with a strategy that's about 70% net exposure, about a 0.6 beta. We want to get you about a 90% up capture and significantly reduce down capture. That's our goal. So we want to provide a consistent product for our clients.
Yeah. Do you mostly work with you mostly manage money for other advisors by the sound of things, not a whole lot of direct clients?
We have a couple direct clients, a lot of relatives, and then we also have mostly it's RIAs. Yes.
Okay, great. I mean, and of course, you teeing it up as if it's really up now. It's up to the RIA to decide how much of your fund to use relative to what the client needs are. So it kind of takes you out of the direct firing line of trying to do the direct asset allocation modeling. I was going to ask a question about how you manage, client expectations, but
Right.
I guess it's not really a suitable question given the way you guys.
Well, some of our clients use us as a bond surrogate. Some of our clients use us in an alt bucket. Some clients use it as an equity allocation. So it's really up to the advisors how they want to use the product.
And I think I heard in there that really your outlook is really only about a month or relatively short duration on your sort of where you think you're going to.
We formally rebalance the strategy every month, and all of our back testing is done with a monthly rebalance to assess whether our factors are effective or not. But with that said, our long holdings, we tend to turn the long book over every year and a half or so, whereas our shorts will turn over maybe 4 or 5 times a year. So the holding period for our shorts is shorter, but it's not a month. We're not turning it over 12 times a year.
Yeah.
So
I mean, and if you have is there a thesis in your short or your long? Like if you're trying to think something that's going to go from $30 to $60, and it's going to take 9 months to do it, but it happens over 3 weeks. I assume the calculus would change and something would be rebalanced out.
More than likely, if that were to happen, your valuation score, all your valuation metrics are going to be either more in favor or more out of favor, and that's going to lower you in the ranking of that industry.
Yeah, right.
So, yeah, it all comes back to the factor score.
So we're using a private company. You built your own models. Do you see anything in financial services, either like maybe with machine learning or any other kind of technology platform, AI or otherwise, that you could see as a game changer or something you really need to incorporate, or something you think is just woof and not going to help that's out there right now?
Not off the top of my head.
Yeah.
I mean, I can see a lot of this. Well, we still have a product that systematic tax loss harvesting. We've run that strategy for 15 years where we track the S&P 500 or whatever benchmark you want. And we systematically harvest tax losses, on a monthly basis at 32 days or so. That was a very unique strategy. And now all the big, not wirehouses, but like the Schwabs and Fidelities are just replicating that same process for free. And they're doing that. They're doing it without, we have a patent on it. It's hanging on the wall in the office. And it's not a patentable thing anymore. It's so much more easy to do with technology.
Yeah.
Well, you usually wrap these things up by saying, is there any question that you wish we would have asked you? So this is your chance to kind of share something that didn't come up or have a conversation about a topic that you think is important that you want to cover.
Well, to expand on, you had asked about my hobbies. One other hobby that I do have is woodworking. I really love woodworking. I like making custom furniture and cutting boards and charcuterie boards. So I enjoy doing that.
You want to plug that on Etsy or anything, or is it just for your own deal?
Yeah, feel free to check me out on Instagram. So yeah, that's just another thing that helps you a little bit better stress relief than the mountain biking.
Yeah, I'm right there with you. I enjoy building things because we live our lives in a world of commas and zeros.
Right.
It's very difficult sometimes to get a physical manifestation of something we've done.
Yeah.
So yeah, I appreciate the physical things being built and.
You just have to look out for the finger things that can happen from time to time.
That is true. That is 100% correct.
In case you're wondering, they're all there.
So a question for you guys, as a smaller, more boutique investment management shop, one of the, headwinds that we always face is trying to get in front of RIAs and just having people take a serious look at us. And a lot of them will say, you guys are fine. Your returns are great. I see you're a gold medalist here, or you have 5 or 10 stars over there. That's great. But from a client perspective, I can't, from a career risk perspective, I can't go with the smaller, more boutique manager. I'd rather go with, the highly recognizable names that everyone's comfortable with. And I feel like that's just a headwind that's only going to get stronger going forward, because I feel like as the clients of the RIAs become more aware and more, they think they're more knowledgeable about it and they want to ask more questions, or they're saying, this product seems to be very high fee. Why can't we get this for 2 basis points? And it's like, well, we think there's benefit to paying for it. But I've had conversations with a lot of advisors and they say, look, I just can't get my client over your 50 basis point fee. And my comment is, my returns are 2% better net of fees.
Yeah, I feel that same pain with you. It's a terrible, terrible answer. Really, unfortunately, I think the main response to that is move on to the next RIA because they're concentrating on the wrong thing.
You're right.
I think the biggest problem that we face is the sort of consolidation onto the TAMP platforms, and the particularly in our case, we're very option driven. In fact, our primary method for getting our exposure to risk is through the use of options, and the platforms just don't lend themselves to that. There's a number of reasons, including the fact that option contracts can't be bought in fractions. We can't do like 0.265 option contracts.
Right.
You can buy 1 or 2, but not 1.5. So we really face some even more difficult hurdles in distribution. I think you have an ETF channel that you manage to.
We do.
Yeah, right. We can't do that, and so it's like whatever hurdles you're experiencing, we're a little bit even tougher.
Right.
So it's definitely a challenge.
I have something to add to that. I think one needs to have that the reason that they're going to be using you can't be based on fees. There has to be some underlying client concern that's being met by using the strategies that you adopt. So right. I think Larry makes a good point that if the RA is kind of giving you the reason why they can't use you, you really want to find the ones who give you a reason that they do use you.
Yeah.
And then check with those guys, like how are they positioning that with their advisors and replicating that model. That it's the classic old some will, some won't. I might next call.
Almost more importantly, that if you're in with a relationship where an RIA is valuing based on fee structure, then you're starting a relationship that's going to fee grind you into non-profitability.
You're 100% right.
So if it starts out at we don't take 50, we'll only do 42. Once they've cracked that threshold, then why not 37? And particularly because they've given you more money. And then eventually it becomes 16 and 8. And then you just have that client because it adds to your AUM value, but it adds no revenue to your bottom line. So
you're 100%.
I think that's a really slippery slope to start with the relationship. It really needs to be something where they value the services you're providing. Because, if you're out there looking for some other service, particularly when it comes to advice, you do not hire the cheapest consultant. When you're talking about,
that's a really valid point.
the people that brag about their services are the ones who are hiring the attorney that's $1,800 an hour.
Yeah.
Right. The reason that attorney gets $1,800 an hour is because they win or they have advice that's going to be that valuable.
Right.
So I think with the right context, you can certainly make a case for the fact that, you should be grateful that I'm not charging 100 basis points because I think it's worth it. And just rephrase the conversation.
Yeah, I'm from South Africa, and we have this little saying over there. It's in Afrikaans, and I'll tell you what it is, and I'll translate it for you. It's goedkoop is duur, which means that the cheap alternative is very expensive. And it's to Larry's point. You don't pay. If I can find you an attorney for $25 an hour, I promise you're not going to want to use that guy. It's like
exactly
you're going to be. It's just.
So from what I've seen of your performance and the structure that you're bringing to the table and risk controls, I would not be embarrassed at all about charging 50 basis points.
Right.
So, and I think it helps to hear that from a peer, just to understand that is the case. So, but good question.
Yeah.
It's very possible that those options could be available in an ETF. We converted to an ETF in February of 22. We were the first long short mutual fund to convert to an ETF ever. And we, figuring out we actually had a conversation with an RIA today. He's like, you can't do shorts in an ETF. I'm like, well, I hate to break it to you, but we can, and we are. And then it's like,
someone hasn't been paying attention to compliance, or we can.
Right. We work with US Bank. They're a pretty big bank. I'm pretty sure they're not going to let us just,
Nah.
it's not the Wild West here. So that was an interesting
That's
conversation.
good. Well, I look forward to continuing the conversation, maybe off camera. And,
Sure.
we do want to keep it to a reasonable deal for our audiences here. So once again, Justin Neuberg with Convergence Investment Partners here in San Diego and elsewhere. Thanks for joining us today.
Thanks for having me.
Thanks for joining the show. Thanks very much.
This interview also may contain statements that constitute endorsements of measured risk portfolios, also known as MRP. Please note that any such statements are not made by clients of MRP, but by representatives of other investment advisory firms that work with MRP. No compensation was offered or given in exchange for these statements. However, a conflict of interest exists due to the incentive to give an endorsement in the interest of a good future working relationship between the endorser and MRP.